Hello, everybody. Welcome back to our Business Tax Fundamentals course. I'm Professor Villar, and in this video, we're doing a deep dive into sole proprietorships, the most common business structure in the United States. By the end of this video, you'll understand exactly when the sole proprietor makes sense, the tax implications, and most importantly, the risks every business owner needs to know about your business entity. If you haven't already watched video 1.1 on, 1.0 on business entity fundamentals, I recommend you start there for a complete foundation. This is our important educational disclaimer. ProfessorVillar.com is an independent educational support service not affiliated with any educational institution. Students enrolled in academic courses should continue to communicate directly with their professor through their institution's official channels and/or learning management tools. The content provided herein is for educational purposes only. While RTH Worldwide LLC may offer professional services through youraccountantusa.com or tuscontadoresusa.com, the use of educational materials from ProfessorVillar.com does not establish any professional engagement or contractual relationship between you and our business or me as your professor. Learning objectives for today, you'll be able to understand everything about the sole proprietorship, formation requirements, tax treatment, self-employment taxes, liability risks, when the sole proprietor makes sense, as well as talk about some real-world scenarios. Let's get right to the basics. A sole proprietorship is simply an unincorporated business that is owned by one individual. Here's the key concept. There's no separate legal entity. You and your business are legally the same thing. This is both the biggest advantage and the biggest disadvantage of the sole proprietorship. It's the default structure, meaning if you start doing business without forming any other entity, you're automatically a sole proprietor. Open a lemonade stand, you're a sole proprietor. Start a freelance consulting, sole proprietor. What happens if you get a 1099 at the end of the year? You're a sole proprietor. Okay. So formation requirements, basically very, very little. Federal employer identification number is only required if you hire employees. Obviously, any business licensing, both at the federal, state, or local level, will be required. However, no other formal documents are required. At the end of the year, when it's time to do your taxes, this is the form that you would be filing. It's IRS Form 1040, Schedule C, profit or loss from a business. Essentially, this gets attached to your individual income tax return with the information of the proprietor. That would be you. So from a tax perspective, sole proprietorships are basically simple. All your business income expenses go on the Schedule C, which attaches to your personal Form 1040. No separate tax return to file. If your business makes money, that profit gets added to your other income and is taxed at whatever your personal tax rate is. If your business loses money, that loss may offset other income on your personal return. This is a huge advantage in the early years when many businesses basically are less than profitable. You get the immediate tax benefits from those losses. Self-employment tax. Here's where many sole proprietors get surprised. If you owe self-employment tax on your entire net profit from Schedule C, that's 15.3%. It's essentially the equivalent of both the employee and the employer's portion of Social Security and Medicare. So let's say your business makes $50,000 in profit. You owe about $7,000 in self-employment tax, plus regular income on that. There is a little bit of silver lining, and that is that you're able to deduct about 1/2 of your self-employment tax, but it's still a significant hit to your taxes. This is one of the reasons why some profitable sole proprietorships eventually elect S corporation status in order to save on their self-employment taxes. More on that in a subsequent lecture. Liability exposure. Here's the big one. A sole proprietor has unlimited personal liability. Since you and your business are legally the same entity, there's no separate legal entity to protect you and your personal assets. If your business gets sued, you get sued. If your business can't pay its debts, creditors can come after you, your car, your house, even your dog. I've seen contractors lose their homes because of job site injuries. I've seen consultants have personal bank accounts frozen due to client disputes. This isn't theoretical. It happens regularly. For many businesses, this risk alone makes sole proprietorships unworkable for a lot of situations. Now, business insurance can obviously help with liability exposures, but it's not a complete solution. General liability insurance covers things like customer injuries, professional liabilities, errors and omissions, but insurance doesn't cover things like business debt, contract disputes, or items that you've personally guaranteed. And then there's always coverage limits, exclusions, and obviously the cost of the insurance itself. Insurance for sole proprietorships is useful, but it potentially is not a substitute for the liability protections that you'll get from one of the other entities similar to what we will be discussing in future lectures, whether that's a limited liability company or even a corporation. When does a sole proprietor make sense? Well, when it's a low risk service type business. That's a good candidate for a sole proprietorship. Things like freelancers, writers, graphic designers, personal trainers. Basically, if you're testing out a business idea, running a side hustle, the sole proprietorship might let you start immediately without incurring any legal costs. Businesses with minimal startup costs, simple operations, often work well as sole proprietorships. Basically, the key factors that have low liability exposure, a simple business model, and limited capital investment may lead you to want to select the sole proprietorship. If you're a consulting business working from home with no employees, minimal equipment, sole proprietorship may very well be a good option for you. When to avoid a sole proprietorship? Absolutely. There are definitely times to avoid the sole proprietorship. The higher the liability business, you should almost never use this structure in construction, food services, or anything that involves the public. If you're investing significant amount of money in equipment, inventory, want liability protection, definitely not for you. Obviously, if you're going to have partners, you can't be a sole proprietorship. Even if you and your wife are in business together, that sole proprietorship is no longer a sole proprietorship. It's actually a partnership. We'll discuss that in our next lesson. So basically, if you're starting one of these red flag businesses, stay away from the sole proprietorship. You'll thank me later. Basically, we'll go into some real world experiences. Basically, Sarah is a freelancer, works from home, has established business clients, relatively low business income. That's fine for a sole proprietorship. As opposed to Mike, basically started as a sole proprietorship to save money. Somebody got injured on a job site, basically got hit with a $500,000 judgment tied to his home because it was the only asset he had. Basically, a lot of this could have been prevented had Mike been a limited liability company or even a corporation, as we'll discuss in subsequent mini lectures. Many businesses will start as sole proprietorships and later convert to other structures as they grow. Basically, it's some signs that will tell you it's time to consider changing to a different business structure. Can be things like increased liability, adding partners or investors, needing additional business banking services and or credit. Some tax planning opportunities. You can convert to a limited liability company. It's usually the simplest way. However, you could also transfer your assets to a corporation. Requires a little bit more planning, but offer some additional benefits. Some sole proprietorships will elect to become an S corporation for tax purposes, which basically gives them all the benefits of the corporation with the savings of self-employment tax that the sole proprietor did not offer them. Again, more on that in future lessons. Some pros and cons. Sole proprietorship is, again, the default tax status for your business if you haven't formed any other entity. It's the simplest structure, but simple doesn't mean best. Let's look at both advantages and disadvantages. Easy and inexpensive to establish, complete control over your business decisions, simple tax reporting, all profits belong to the owner, and can be easily dissolved. However, some of the disadvantages to consider are unlimited personal liability, self-employment tax on your profits, difficult to raise capital. If the business owner dies, so does the business. Limited business deductions as far as what would be deductible to your sole proprietorship. What are your action steps? Basically, assess your liability exposures honestly. Consider business insurance as a possible alternative to provide some additional security to your sole proprietorship. Evaluate your long-term business goals and consult a professional if you are in a high-risk business. Upcoming mini lectures, we'll talk about partnerships, limited liability companies, corporations. Then we'll get into government reporting hierarchy, business startup process, where we will cover all of your licensing needs. Again, Robert Villar, ProfessorVillar.com. I hope this lecture has been useful. Click and subscribe. We'll see you in our next lecture.